There is a way to sell your business, create liquidity, and transfer ownership to your employees. But most owners don't fully understand how it works. My guest today helps us understand what ESOP or Employee Stock Ownership Plan is and when it can be the right path. Welcome to Business Beyond You, the one-stop hub for insights, conversations, and perspectives business owners need to build businesses that last beyond them. Hi, I'm Sara Vaziri, M&A advisor in the state of California, and my guest today is Anthony Levi of Tenor ESOP Partners, who helps owners evaluate and execute ESOP transactions from start to finish. Anthony, welcome to Business Beyond You.
Thanks, Sarah. Looking forward to a good conversation.
Awesome. So let's start it simple for the audience who are not familiar. Tell us exactly what ESOP is, very simply in plain language.
Well, Sarah, an ESOP stands for Employee Stock Ownership Plan. And essentially what it is an employee benefit plan under ERISA, which is the same legislation or law that covers pension plans and 401ks. But the relevance of ESOPs in your world is that many people use an ESOP as a way to structure a sale of their company to their employees through a structured exit.
Oh, okay. So if we want to look at it as a technical wording, it's more like a retirement account, something like that. But it's a tool that they use to sell it to their employees.
Exactly. So from the perspective of the employees, it's a benefit plan which allows them to participate in ownership of the company. Mm-hmm. And for the business owners, it allows them to, over time, sell their business in a very structured and controlled manner while remaining in control of the business into the future.
Okay. So business owners, when they get to the time that they are thinking about what options they have, because now is the time they want to get retired or whatever, they compare different options. One of them is this ESOP. Very simply, what kind of businesses could be a good fit for this program? Is there any level of income, any number of employees that they need to have to consider ESOP as a viable option?
No, that's a great question. And we often get this from people who are exploring, what their options are to exit their business. I think the most important thing is that an ESOP exit can be viewed sort of as a slow glide path to retirement. And so if a business owner is looking for a quick exit, if they don't have any runway left, it's probably not a good option. But if somebody has, let's say, 5 or more years of runway and they want to remain involved in the business, at least at the governance level, then an ESOP may be a good fit. The other thing to note is an ESOP is sort of a leverage buyout in that the trust is buying the business out over time. So what's super important is that the company has positive cash flows because otherwise, the debt that will be on the books can't be paid off. So we're typically looking for companies that are mid-market companies that maybe have over $1 million in profit. And then, usually a workforce of at least 20 people, because ultimately this is something that is enabled through transitioning business ownership to the employees themselves.
Okay, so you want them to have at least 20 employees and more than $1 million profit in the business to consider this as an option. So, okay, I'm an owner. Let's start this today. When do I get the money? Because when I sell my business, I get part of it now. If I do seller financing, it takes like a few years to get it. In ESOP, when do I get the money and where that money come from? Because the employees don't pay any money, correct? So where does this money come from?
Now, you make a really good point, Sarah, which is the employees themselves are not buying into the company, they're earning into the company. And so the money has to come from the profits of the business. And so, in this way, sellers are going to draw the money down over time. And there is a way to get some liquidity at close through some bank financing. And that is quite typical. But it is a structured exit over a number of years. And what we typically see is that people are able to realize the purchase price between, let's say, 3 to 5 years. And then there are some additional components of the transaction that enable the shareholders to maintain some synthetic equity, and that allows for a future liquidity event. But, we're looking at sort of a 3 to 7 year runway and maybe longer for a business that is valued higher.
Okay. So this is day zero, we start. And based on what you explained, is this my understanding correct that there is something like a trust that buys this business? This trust might get a loan to pay me as the seller, at least a part of my proceedings. And then it's like that the business pays back the trust for the loan that they have got. Is this understanding kind of correct, or is it
Well, Sarah, I think
complicated?
you're getting into the weeds, maybe because and it is somewhat complicated too. So to keep it simple, I would view it this way.
Mhm.
Uh, Rather than find a third party to buy the business, whether it be a strategic acquirer or a private equity player, instead, the owners of the business are creating a trust and they're going to sell their shares to the trust. And the trust is going to, over time, allocate those shares into employee accounts. And so I know this sounds a little complicated, but there's basically a loan from the trust or from the company to the trust, and then there's also a loan from the shareholders to the company. And through this mechanism, and they have different amortization schedules, through this mechanism, you can structure a transaction that works very well for both the shareholders, the company, and ultimately the employees.
So they say that ESOP has a very good tax advantage. What is that? How does that one work?
There are a number of unique tax advantages that can be structured in an ESOP. And the most commonly known tax advantage that is really important to selling shareholders is the ability to sell your company to a trust and defer the capital gains tax. And that deferral, if structured properly, can become permanent. And in this way, sellers can essentially sell their company to the trust and avoid paying any capital gains taxes on that sale. And this applies at the federal level and in most states. In fact, the vast majority of states mirror the tax advantages of the IRS. And as a result, you can walk away with a lot more net wealth as a selling shareholder because you've essentially avoided paying gains tax.
Okay.
So that is the first commonly known benefit, tax benefit of a sale to an ESOP, which differentiates it from a third party sale. The other major benefit is that the company itself can be eligible for some significant tax reductions. And ultimately, in the way most of our clients structure their transactions, their company, after the close, becomes a for-profit tax-free business. And what this allows is a considerable amount of money that otherwise would be going to the tax authorities is captured within the structure and is available first to pay off the selling shareholders. It's also available for growth of the company, and ultimately it's going to fund the employee benefit plan.
Very interesting. So you said for profit taxes exempt.
Yeah, so that one is a head scratcher for most people. But the way to view that is, um, if a company is an S corporation and therefore a pass-through entity, uh, ultimately the shareholders of that company are liable for the taxes of the earnings of the company.
Right.
If the S corporation is owned by an ESOP trust, an ESOP trust doesn't pay taxes, and in this way, the tax obligation is eliminated.
Oh, okay. That's very interesting. Now, okay, so we sell the business to this trust. What is the valuation? Who decides what would be the price for selling? Because when we sell the business, we put it in the market. There will be a market price that they sell the business. But in this case, who decides about that valuation?
Yeah, that is a very important question, and it actually touches on some of the misconceptions people have about ESOPs, which is, you're doing this wonderful thing for your employees. You're creating this employee benefit plan where the employees are um, going to be granted shares over time, and so most people think, well, I've got to be giving up something as a shareholder or as a business owner in order to create this benefit for my employees. The reality is that the ESOP transactions, the ESOP trust will pay basically what is known as fair market value for the company. It is a market price. And the question is, how does that market price get determined? And it is essentially reached through an arm's length negotiation between the sellers and the buyer, who is a trustee brought in by the company to represent the employees. And the trustee is advised by a valuation advisor who specializes in ESOP transactions. And so ultimately, the trustee's fiduciary responsibility is not to overpay for the company, but the trustee is willing to pay a fair value for the company. And that is typically, within 10% of a very competitive strategic acquisition at a premium. And it is usually significantly more than what private equity will pay for that same business.
Okay, okay. But even if we find a strategic buyer who is willing to pay more than that price because of those tax savings, still it might be a better choice for the sellers to do that, correct?
Well, that is true, Sarah, but you're also raising another point, which is sometimes a seller is evaluating their options and is doing a parallel path where they're exploring a strategic sale and then maybe looking at an ESOP as an alternative. And to the extent that there's a bona fide offer from as a strategic acquirer, that does factor into what the fair market value of the company is. And so if we can demonstrate that there are willing buyers willing to pay a certain price, the valuation advisor will factor that into their analysis. And, because it's demonstrating that the company has that market value.
Okay, okay. So let me get back to the point that you said at the beginning. You said that it's a good option if a seller wants to sell at least 5 years from now. So when exactly, my understanding is that eventually if a seller wants to go out, they, they, there need to be replacement for everything that seller does. Who makes this replacement system? Is it the seller who needs to do that, or is there any help to do that?
Yeah, it is a good question, and it relates to succession. So we've talked a little bit about exit, which is using an ESOP as an alternative way to sell your business. But the other component is succession, which is who is going to run the business after the sellers have fully exited. And an ESOP actually doesn't solve that problem, but gives the seller tools with which to solve the problem. The the end game is ultimately that the sellers will start to do the transaction, start to pull their money off the table over time, and while doing so, develop and execute the succession strategy. And that includes finding a CEO and an executive team and developing that team to take over operations of the business, allowing the seller to fully exit. So sellers basically there's a transaction side which relates to how they pull their value off the table, and then there's a succession side in which they identify the key people who are going to run the business in their absence, and ultimately transition control to those people.
Okay. So they don't need to do those steps before selling to ESOP, correct? They can sell to ESOP, and during that transition process, they can work on those steps.
Yeah, and that is one of the benefits of an ESOP is that it allows a seller to nail down the value of their business, sell the business, and start to harvest that value while they continue to work on the business and develop their successors. And then ultimately, before they fully exit, they will they will exercise the warrant position, which is that synthetic equity I previously described, what we call the second bite of the apple, and hand the keys over to their successors. And along the way, the sellers would have created a board of directors to oversee the company and to serve as in the governance role.
Got it.
And that board of directors uh, is ultimately the group that controls the business after the sellers fully exit.
Got it. Got it. So, I know there are a lot of details I would like to ask you, but we are getting to the end of our time. Just one last question. I know that you have worked with a lot of people who wanted to do ESOP. Was there any time that you would see some red flags in a business or a situation that you eventually tell a business owner, no, I don't think it's a good path for you? What are those red flags that if you see, you say that, no, don't think about ESOP?
Yeah, so that's a great question, and a good ESOP advisor will identify that right up front in a process called feasibility. Feasibility is essentially a conversation that we have with the selling shareholders to identify and determine if they are a good fit for an ESOP. Obviously, that feasibility depends on them providing us information that would hold up under due diligence. So that includes the viability of the business, the fact that it is an ongoing concern that generates cash, and what we can do through asking, let's say half a dozen questions, is figure out if it's feasible to do an ESOP transaction. And once we've done that, uh, it is always possible to complete a transaction unless, of course, something materially changes during the process.
Hmm. Hmm. Well, okay, awesome. So if somebody is thinking about doing ESOP, they can reach out to you. Can you tell our audience how they can reach out to you? What's the best way to get hold of you?
Absolutely. Sarah, firstly, just simply send me an email. My email address is levi@tenoresop.com, spelled Levi at tenoresop.com. And I think you'll put that contact information
Yep.
in the notes. We also have a website, tenoresop.com, and you can reach me through that website. I encourage anybody who is just interested in learning about an ESOP to reach out to me, and we can discuss it, and I can provide some education. And if it seems like a fit, we can take you deeper down the rabbit hole.
Okay, awesome. Thank you so much, Anthony, for your time. It was great information, and I hope to talk to you again with more details.
Okay, well, Sarah, thanks for having me on. Very much appreciate your interest in ESOPs, and it's been a wonderful time chatting with you today.
Thank you. Have a great day.
You too.